Well, we're seeing more economic fallout now from the effects of the Wu flu, of the coronavirus that's going around. Uh, of course, from the beginning, I've been discussing the economic impacts of this and what potential disaster it could bring. I've never really focused much on, what the actual toll in terms of human life or health, of individual people, it could bring, which, of course, in and of itself is a big problem. But I've said from the beginning that what really is going to affect most of the people on this planet, whether they get sick or not, are the economic effects, which are going to be remarkably greater than just the health effects, because these sorts of system-wide problems are going have ripple effects that ripple out across the entire economy and affect everyone, whether they themselves personally get sick or not. And the ordinary people in this country, despite what they're being told in the media, seem to understand that this here is the real risk, because with all this panic buying that's been going on as a result of increased fears over the Wu flu, you haven't just been seeing people going out and buying masks and buying disinfectant. Of course, that is still the bulk of what people are doing, because first and foremost, people are concerned about getting sick. But you also see people going out and buying essential items that they would need that may or may not be available in the middle of a crisis in which, say, there's this, they quarantine entire counties, or in which the supply chains break down. So people are going out and stocking up on things like toilet paper. And, of course, the same smug people who, a couple months ago, or less than a month ago maybe even, were on the internet saying, oh my gosh, this disease has only killed 15 people in China, you're so scared, blah, 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 are now the people going, also making fun of these folks stocking up on toilet paper, going, oh, toilet paper's not going to keep you from getting sick. And these mouth breathers are so satisfied with their own intelligence, or are so impressed with themselves that they can't be bothered to look a little bit ahead of the curve to see that, hey, perhaps, back when you weren't worried about getting sick, perhaps that there's a possibility that things might change and that maybe this virus gets out of China. Now, these people are saying, oh, well, look, your only risk is to getting sick. And maybe you should look a little bit far ahead of the curve and say, well, if everybody gets sick, well, then isn't that going to have some impact on the economy? Couldn't that lead to disruptions in our just-in-time economic system? And so the bad news I have today is related to that, because we're starting to see the effects of this show up. As I've said since I started this channel, the U.S. economy is incredibly over-leveraged. The result of the response to the 2008 financial crisis was to, on the part of the authorities, was to try and just get people to borrow more money and to go deeper in debt and to, reinflate asset prices. And that's what we've done in the last 10 years. That is a very short synopsis of what happened. Essentially, everyone took out money or borrowed money from banks that was printed by the Fed in order to go buy risk assets. So we drove up the price of stocks and housing and lots of other things. And so because of that, after 10 years, everyone, instead of having a lot of prosperity and maybe paid off their debts a little bit, or even have built up a bit of a supply of reserves, of savings even, something like a rainy day fund in case, hey, there's some kind of economic disruption. Here's some extra money that I'll have in savings so that I can pay my bills. People just have more debt. They have more debt than they had in 2008. They have more debt than at any time in history. And this is not just the federal government, which people always like to talk about as the federal government debt. But the federal government debt is the least of my concern, because the federal government can always print its way out of debt. Nobody else, though, can. U.S. corporations and individual people and families and households, they can't print their way out of the debt. And so if anything happens to disrupt, their cash flow, their income, they are going to have trouble paying their bills. And that's what we're starting to see show up now in the credit markets. Because not only do we have a just-in-time system when it comes to delivering goods and producing goods and our just-in-time supply chains, we have a just-in-time financial system. To where everyone, is sending money out and paying their bills as fast as they're making money. Nobody is taking in more money than they're sending back out. In fact, in most cases, as I've been saying, people are spending much more than they're taking in, and so debt is constantly rising. That's what's been increasing the size of our economy. Our economy is all based on debt. So as soon as there is a bit of a disruption in cash flow, meaning that because of say a bit of a supply chain shock, a supply side shock, companies are not taking in as much money than they expected to take in. Well, then all of a sudden they are having trouble paying their bills, and that shows up in the repo markets. And without getting into too much detail as to why that's the case and how that reverberates from companies into banks and their creditors, all you need to know is that the repo market, the repurchase, the market for repurchase agreements that the Fed has been so heavily involved in since last year, is sort of the last place. It's place of last resort when financial institutions and non-financial institutions actually really need money. It's where people go to get money when they have no short-term liquidity, when they own assets but don't have enough cash to pay their bills. And the Fed has had to intervene in this market to keep it afloat, to keep essentially people from going bankrupt since last September. The Fed had not been doing that at all since the 2008 crisis. The repo market had been able to operate on its own, of course, in a still very heavily manipulated overall market, but the repo market itself did not need direct Fed intervention. Since then, it has had direct Fed intervention, and since the start of this, since the Wu flu panic finally started to set in on Wall Street, the Fed has had to dump a lot more money into the repo market, and for the last 3 days, I believe the Fed injected over $100 billion into the repo market every day, and every day that repo was oversubscribed, meaning that more people wanted money from the Fed than or there was more money demanded by people who needed money than the Fed was offering. And so this is a sign that the Wu flu is having an impact on the conditions in the financial market, in the financial system, not just in the equity markets. It's not just resulting in people selling stock; it's resulting in people not being able to pay their bills to keep the gears of the financial system greased, to keep it turning. There is not that liquidity that is required. And so this sort of sign is, an example of something that could turn into a financial crisis. This is the sorts of thing. This is how financial crises occur. You have, essentially a locking up of credit markets to where things don't work anymore because people can't pay their bills and they start defaulting. And if they start defaulting, well, then people who, were exposed to their debt, then also, lose a bunch of money and they end up defaulting on their debt, and it creates this spiral. And so we're seeing again, just like we saw last September, that if the Fed does not, directly intervene very quickly in a very direct sense, in directly, extending cash and giving money to bail out Wall Street, the credit market is going to lock up and we'll have a financial crisis. This could have happened last fall. But the Fed intervened to stop that by conducting their repo operations, and they've been able to supply the repo market with enough credit, with enough liquidity to where it has been kept afloat. And so what we would seem to expect now in the immediate future is that the Fed is going to extend a lot more liquidity to this market, because that is what it's showing that it needs in order to stay afloat. Now, I'm not saying that that's necessarily a great idea. The Fed is just kicking the can down the road by doing that. And frankly, considering how bad this crisis is, it's not necessarily the case that the Fed doing so and just injecting more money into the system can keep everything afloat. There's a lot of balls in the air right now, and it's frankly getting a little opaque for me to really understand and interpret. But even a somewhat lay person such as myself, because I'm not someone who works on Wall Street or whoever has, can still understand that there's something very scary going on here. And of course that the financial system, as it has been, I guess, manipulated by the Fed, not only over the last 10 years. It's hard to say at what point you can go back to where we weren't in this state, but over time we've gotten to the point to where the financial system has become, thanks to the Fed's interventions, more and more, I guess, short term-oriented and fragile. I mean, it really is just like the just-in-time supply chains. No one has any savings in case that there's an unexpected eventuality in which they don't take in as much money as they were expecting. Everyone is operating on a very tight leash. And so even the slightest disruption is going to have a very severe impact. And even after that disruption has come to pass, let's say that this virus is contained by August, and that by the end of the year we'll think back and go, haha, wasn't that Wu flu thing funny? That we were all so worried about that, and nothing became of it. Even if it disrupts the supply chains for only a short time, that can be enough to wreak complete havoc and to collapse the system, because there is no wiggle room here, either materially in terms of having enough parts in inventory to continue producing things, even if say one of your intermediate suppliers is unable to deliver on time. There's that kind of problem with the just-in-time system, but also the fact that financially there is no wiggle room, because everyone has to make those payments, and they have barely just enough money to keep paying the interest on their debt, not paying down their debt. That everyone is indebted. That there really is no one who has a decent supply of savings. And of course, I haven't even gone into how all these disruptions are likely to lead to downgrades in the corporate bond market, which of course, as I've been saying, is incredibly over-leveraged, is incredibly bloated. And so if say because of the economic implications of this virus, a bunch of companies get downgraded from investment grade to junk bond status, they are then going to have to pay a higher rate of interest on their bonds, on their debt. Their debt will cost more to service, and therefore a lot of them are not going to be able to pay that, since they barely can pay the rates that they get now. And therefore you're going to see a bunch of defaults, and this is going to spread like wildfire throughout the economy. And so my point is that this is an additional problem on top of the virus. This is independent of the virus. If our system was not so indebted, well, then perhaps this virus would not cause would not wreak such havoc on the same degree. The real cost would be in the short term to the actual output. The virus the virus's effect on the economy would be limited to the period in time in which the virus is itself actively a problem. But the way things are now, the damage that will be done by this virus will not simply be repaired by the virus going away. You can't just close down all the factories and hunker down for a couple months and then turn them all back on again, because by the time you go to start the factories back up, everything will have come unglued. No one can afford to just sit idle for a couple months and ride this storm out. If their output is disrupted for a certain period of time, they probably won't come back from that. They won't be able to start back up. And so the big question here is, considering that, based on all of this, it's pretty clear that what the Fed is going to do is just print more money, just like they always have. They're going to print as much as they feel like they need to in order to keep things from coming unglued. But will that be enough? Will the Fed be able to help this market limp along, during the time of malaise, when there's going to be a contraction in output? Will they be able to keep every company afloat? Will they be able to keep the banks afloat? Will they be able to keep the money flowing even if goods are not? My judgment tells me that they probably will not, because currently, right now, in when times are good and when there is there was no virus, it still took almost every ounce of ammunition that the Fed had on reserve to try and keep this market afloat, even without the virus. The Fed has already been throwing massive amounts of liquidity at the market. And, you might say, well, the Fed has, an unlimited printing press. They can just keep making money forever. Well, at what point does the Fed print so much money that it loses its efficacy, that it loses its sting, the amount of money? That's a question that I think we may, learn the answer to here real soon. The best case scenario certainly is Japanification, which I've outlined in the past, which of course is just stagnation. The Fed keeps printing and printing, and they can't make the economy grow, but they can keep it from crashing. And that, I think, would be certainly, that's, based on what the officials have been talking about, based on what the economic establishment has been talking about, that seems like, a very laudable goal as far as they're concerned. But of course, once you get to that stage, there is no coming back. And so at that point, where we will be is something that I discussed maybe a couple months ago. I think I had a video entitled, The End of Economic Growth in America. Is it coming? And this certainly, if this is the Fed's response, if the Fed, is able to stop a recession at all costs, what we will see is the cessation of growth of the American economy. Things will just plateau from here. If we don't allow that big crash to happen, things will never go up higher than they are right now. This is as good as it gets if that's what the Fed chooses to do, and two, if they are able to do it. It's still an open question if they're able to do it, but the best case scenario is an economic malaise. Of course, that's a malaise after probably a short or a small dip relative to what the dip actually would be. So we would still have a recession. That seems to me, unquestionable. And that seems to have become over the last few days, like the last week, a very mainstream opinion that there will be a recession because of this. But the question is how deep and how long and how lasting will the effects be. So with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.